Hey, greetings traders and investors. Ben at TyndallTradingAnalysis.com. It's Tuesday afternoon, October 19th, 2021, and this is your public market update. A lot's happened since we last met in September. If you do not follow our Wednesday live stream show, it's a fantastic way to stay up to date with myself and the rest of the team every Wednesday, 8:45 Eastern, right here on the Trading Analysis YouTube channel. Please check it out if you have the opportunity to do so. Every Thursday morning, 9 a.m. Eastern, Alex is in for the Crypto Lab, mostly focused in the crypto space, but he does touch on the macro front, given his institutional background. Okay, so let's jump into it, and let's first talk about what's happened in the Nasdaq 100 since we last met and discussed the major zone of resistance between 15,500 and 15,700. If you'll recall, or if you attended any of our webinars earlier this year, we have been monitoring an upside resistance cluster in the Nasdaq that we felt could yield a corrective pullback that exceeded 10%. Now, unfortunately, when the markets met the 15,500 to 15,700 upside resistance cluster, price action went mostly sideways, as you can see here between September 1st, and it wasn't until September 10th that we really started to break south of that wave 4 low from the August 30th pullback. Now that we've seen this corrective pullback, you'll see here that we peak to trough about an 8.3% correction in the Nasdaq specifically. Now that we've seen the correction unfold, the question now becomes, where do we go from here? And more importantly, does the three-wave correction into the October 4th low satisfy the requirements to be of the higher degree orange wave 2? The answer to that is most certainly no. The largest correction that we've seen in the Nasdaq from the March COVID low was about 14.5%. Given the fractal nature of Elliott wave, you would not expect a child wave to be a larger magnitude correction than its parent wave. So for that reason, in the event that we have now squeaked out a three-wave completed correction and are resuming in a motive trend establishing fashion, we have two things that we have to look to do as Elliotticians and as investors and traders. The first question becomes, number one, where does this three-wave corrective pullback fit into the larger picture? We've continued to remain optimistic at Trading Analysis. We view markets as still contained in a higher degree, longer-term uptrend. So our advice to clients was, even in the event this proves to be a larger 15%, 20% correction, we would then view that to be a buying opportunity, only setting markets up for continuation on the upside. So what we've seen here is pretty much a spot-on measured three-wave decline. Let me go ahead and redraw that so it doesn't snap. So here in the Nasdaq, you'll notice that we print a 5-wave leading diagonal in wave A. This is an expanding leading diagonal, so you have progressively larger segments. We then have a very sharp retracement in the B wave. Once we broke south of the lower support shelf in the B wave, we continued to move impulsively lower. Meta quality of price of wave C compared to A, and we have now retraced better than 61% of the decline. In fact, you can see today's close here on Tuesday the 19th into the 78.6% retracement of this three-wave sell-off. So again, the first question, where does this three-wave move fit into the bigger picture? The second question is, where do we see the trend in terms of pattern developments, and when and where is the appropriate time to get back on board the market? First of all, let's answer the question regarding where this three-wave corrective pullback fits into the larger picture. Taking you over to our daily chart view, we can take a look at a daily chart of the Nasdaq 100 going back to the March 2020 COVID lows, where we completed a 3-3-5 Elliott wave flat, and we are now resolving higher. in this particular wave count, we've got our orange primary degree wave 1 and 2, followed by intermediate 1, 2, intermediate 3 and 4. Intermediate wave 3 was about 161% of wave 1. And if you'll notice here, the wave 4 low, the actual low of the correction, met equality to the wave 2 counterpart. From there, you'll notice the actual blue wave 5 of orange wave 3 market high came in more or less in line with wave 5 fib projections. From there, we would be viewing the 3-wave pullback, measured move decline, to be of the wave 4 primary degree, thus setting us up now for continuation. So from the daily back down to the 195, we'll take you all the way down to a 20-minute chart, and let's talk about how price action has unfolded from the October 4th lows. Okay, now that we've answered the question regarding where this correction fits in terms of degree of trend, let's talk about when and where this market confirms the uptrend resumption from an Elliott wave perspective. So let's zoom in here from the daily. Let's go upper right-hand corner of your chart. We're going to go from the daily to the 1 hour. I'm going to take you straight to the 15-minute chart. You can see the yellow circle for context. So down here on the 15-minute chart, I'm going to first delete what I have here, and we'll go from scratch. So from the lows in the Nasdaq 100, you might be inclined to say, oh, well, this looks like wave 1, this looks like wave 2, this looks like we're going to be 3, 4, and eventually 5. Okay, first of all, if this is your wave count, you must not like the rules and guidelines of Elliott wave. And if you don't care for the rules and guidelines of Elliott, you should not be using Elliott. As we know, a 3-wave subdivision in a wave 1 position can only occur in motive diagonal instances. So, if this is a motive diagonal advance, it would be, of course, of the expanding variety, where 3 is larger than 1, 4 is a larger net percent retracement than 2, and 5 is larger than 3. This has been satisfied, meaning we have what can technically be counted as a leading motive diagonal. Motive waves establish trends. So this is completely valid, and this is one possibility. This possibility needs a 3-wave corrective pullback to set in at some point to confirm the uptrend move. The other possible wave count that you might see here and say, well, gosh, what if this is the case? Why isn't it 1, 2, 1, 2? Well, this would be a massive degree violation in that the child wave, okay, the smaller degree child wave to the higher degree parent wave would be of a larger magnitude and also of a longer duration. Degree violations can be accepted if it's not both a degree violation in price and time. In this instance, we have a degree violation in price and time. So 1, 2, 1, 2, out of the question, deleted. Okay. Now, there are a couple of hints in this particular chart that lead me to believe this is wave 1, but our wave 2 occurred on October 13th, last Wednesday. Allow me to illustrate further. This wave count is currently my preferred view of the Nasdaq. And what this wave count suggests is that from the October 6th low into the October 7th high, we correct in 3 waves. Notice the 7 swing nature of this correction. 1, 2, 3, 4, 5, 6, 7 major price swings. This is a perfect example of A, B extended C. So from there, we do 1, 2, 3, 4, 5 waves down. Wave C was about 138% of A and about a 786 retracement of B. That then means that we need to see wave 3 find resistance between 15,417 and 15,666, and then look for a wave 4 correction. Once I see a wave 4 correction set in, depending on where it concludes, I will look to then position for a continuation move in wave 5. From there, we'll complete a wave 1 of a higher degree, retrace, and do it all over again. But until we see the next pullback set in, I cannot yet sound the all clear for uptrend market resumption. The reason being is this technically can still qualify as a counter trend move back to the upside. I don't think it's there based on the flows that I'm seeing, based on some of the rotations that we're tracking in Optima. I don't think it's the case, but it is a possibility. So that's the Nasdaq 100. The Nasdaq 100, we do feel, will yield a corrective pullback, offering an entry for an options trade back through the previous all-time high. Let's take a look at the S&P 500. In the S&P 500, we've also been operating under the same degree of trend, which suggests we're still contained in the same impulse from the March COVID low. If that's the case, we need to see a correction that exceeds 10% to qualify to be the larger wave 2. Here in the S&P, peak to trough, 5.87%. So that clearly does not qualify to be of the higher degree wave 2 position. Very similar to the Nasdaq, we have to answer two questions. Question number 1, where does this three-wave move fit into the bigger picture? Just as we discussed in the Nasdaq, we view this to be of the wave 4. We view this to be a wave 4 correction, rather. In the case of the S&P, we did not meet equality of price or time in C compared to A. However, the overall fourth wave did exhibit equality to its wave 2 counterpart. So, in the S&P, we have the exact same possibilities at work. Either we are in a leading expanding variety diagonal, and we will be met with a sharp wave 2 sell-off and then rip back through the highs, or alternatively, this is a flat concluding on October 13th, and then continuation higher in 3. We've met the 200% 3V1 projection. We would then look for wave 4 and then position for continuation through the all-time highs. So that's the indexes. There are a couple of other macro developments that we are tracking. If you keep up to date with our Wednesday live stream show, you'll know that we've been bullish crude oil. Crude oil, we brought the key trend line break to your attention a while back. This particular trend line is of major significance, dating back to 2013. So we're talking a nearly decade-long downtrend resistance line, which has just flipped and turned into support. So the move that we're looking at here, as you can see here in wave A, finds resistance in 2013. So that's where the trend line is sourced. It's then drawn and established in 2018. It was resistance in March of this year. We also had convergence of a lower support trend line shelf that failed back in February of 20. So we had the convergence of those two trend lines. And if I take you down to a smaller time frame, first let me go weekly. You can see trend line in green here, trend line in blue here, weekly to the daily, zooming in to the daily. Here's the first interaction with the 7+, 8+ year downtrend resistance line. We consolidate, we move back up, we find resistance once again, we set a higher low. This time we reclaim support into the blue lower support shelf trend from the weekly back to the daily. We then rally impulsively. We correct in 3 waves. We had a very clear zone of support, and now we're seeing continuation higher in crude oil. We do see a series of 3-4-3-4 consolidations that need to satisfy prior to what we feel will be a move north of 90. So that's an interesting development that we are watching. We're also actively tracking the move in the US dollar. As you know, we've been looking at price action here in the dollar from the March COVID highs as impulsive to the downside. The impulsive move to the downside has been met with a sizable retracement. We're tracking a couple of different possibilities here. The first possibility is that from the May lows, we have 5 waves up, concluding in July, 3 waves down into September 3rd. The September 3rd support has now given way to 1-2, 5 smaller waves in orange 3. Orange 3 met a 200% projection of orange 1. ABC into a 38% retracement, done so as a measured move decline. This now says that the dollar has another rally left to go. Alternatively, the B wave of the green minor degree is still ongoing. The recent high was simply a B wave inside of minor degree wave B, and we are now moving impulsively lower. That's a major development we are tracking with our clients as well. Okay, and the last chart that I wanted to put in front of you this evening was the 10-year yield. Back in March, the 10-year yield met resistance at 1.75% and proceeded to sell off down to 1.13% into the August low. That netted about a 38% retracement of the rally from the August 2020 low. And the question now becomes, is price action from the low corrective or trend establishing, motive diagonal, or motive impulsive? To answer that question, let's zoom in from the 195 to the 1-hour chart, and let's dissect the structure of the pattern from the low. So first of all, let's bring in a simple Fibonacci retracement of the move from the high into the August low. The 786 retracement, which did act as resistance back on October 8th and October 12th, has now been exceeded. We closed at 1.635% this afternoon, and this is something that is most certainly of concern. So the question now becomes, is this 3 waves or is this 5 waves? Let's dissect. Zooming in on price action, I see a clear initial 5-wave rally, a clear sideways consolidation, and now a secondary move to the upside. If this is in fact a corrective structure, I would view this as having concluded on October 8th. This would include a 5-wave move up, a sideways complex combination, ABCW, ABCX, ABCY, 1, 2, 3, 4, 5 waves of C. Remember the discussion regarding measured move projections? Here's a fantastic example. If we were to take a Fibonacci measurement of the August 3rd through August 12th rally in the 10-year, project it from the September 14th low, we would find equality at 1.54%, which is where we met resistance on September 28th, but we then correct in a 3-wave move into the October 4th low, rally higher into October 7th and 8th, correct, and here we are, once again, pressing the 786 retracement. If we see continuation, I have no choice but to view this move as an impulsive structure. Now, if you're new to Elliott, you might be looking at this and saying, well, gosh, let's move wave B here. Let's move wave C here. And let's view this as an ending diagonal. What's wrong with this picture? Anybody? Anybody? If this is an ending diagonal, based on the relationship of blue wave 3 and blue wave 1, this would have to be of the contracting variety, meaning progressively smaller segments of the wave structure. If that's the case, we needed wave 4 to not exceed a 6.636% correction, where wave 4 was 6.8%. Now, it is a fairly minimal invalidation, but the bigger, more concerning technical development is the close over the 786 retracement. If we see continuation over the 786 retracement, we know that often opens the door to the move to a 1272 external retracement, and that would take the 10-year yield up to 2%. Now, a move to 2% given the economic recovery would not be a major concern, but it is a development that we're continuing to track with our clients. Now, should this be an upside impulsive breakout, let's talk a little bit about where this might be heading. If this is an upside impulse, I would suggest these to be corrections of the same degree, which means they should be equal in price. Oh, and certainly are. From there, we would then look to see where our wave 5 fib projections take us in relation to the higher orange wave 3. The orange wave 3 1618 fib projection at 175 sits just above our blue 5 versus 1 and 3 at 1.67%. That's something that we're going to continue to track with our clients. Very curious to see where that ultimately takes markets. All right, that's it. We're going to go ahead and leave it at that. Traders, questions, comments, concerns, you know where to reach us. You know what we're looking for. Please join us tomorrow morning, 8:45 Eastern, right here on the Trading Analysis YouTube channel. You can, of course, check us out anytime, tradinganalysis.com. Thank you all so much for tuning in. If you did enjoy the content, please give it a thumbs up and subscribe with notifications. We'll see you guys on the next market update. Take care. See you then.